Thank you all for attending. I believe that retired persons should be tax exempt, free from all income taxes. I also believe that most Americans are overtaxed. The reason that most Americans are overtaxed is because we focus on the wrong side of the tax return. And when we do have a tax plan, we don't focus on what really is critically important. In my opinion, it's extremely important to create tax-free income versus writing a check for a tax deduction. My name is Injil Muhammad, and I've been in the space of tax strategy and tax planning for the past 25 years. And over the years, I've learned a lot about really what this whole process is about. And if I can sum up my years of experience in 4 words, I would say that money is taxed differently. And it's very important that you understand that when you work as a W-2 wage earner or even a business owner, your tax is ordinary income. Your income, I should say, is considered ordinary income. Ordinary income is taxed at the highest possible rate. And presently, the highest rate is 37%. But here's the thing. When your money makes money, it's taxed differently. It's taxed at a much lower rate. In some cases, half of that. So what's important is to understand, where is your money? Is your money in the tax-free lane? Is your money in the taxable lane? Is your money in a lane that is going to have capital gains where you pay a better rate? So it's very important that we understand how our money is taxed, because it's very, very different. Now, when we talk about tax planning, regardless of what plan is put in place for you, that plan is going to fall under one of these 3 rules. And I call these the golden rules. And the first rule, I think, is the most important. That is, pay taxes at the lowest rate possible. Sounds simple, but it's not that simple. The second rule is defer income into next year. If I can pay taxes on income in a future year, that's a good plan. And the last part of this is to bring deductions into the current year versus putting those out into the future. But we're going to focus on the first rule of tax planning, and that is paying tax at the lowest possible rate. Now, we go a little deeper. When we work on a tax plan for a client, we have 3 categories. And the first category is to bring tax-free income to your tax return. What are we talking about? We're talking about Roth money. When you have money coming to you from a Roth account, as long as qualified money, it's tax-free. If you have money coming to you from an insurance policy, it's tax-free. If you sell your home and you qualify for what is called a exclusion on the amount of tax due, if you're single, it's $250,000. If you're married, you're on this $500,000. So the point we're trying to make is that we want to bring income to your return that's tax-free, because that's better than writing the tax deduction. The second area we looked at, prepare your expenses for deductibility. What do we mean by that? Let's say, for example, you're a business owner and you have small children who could actually work in your business, as opposed to paying for them to go to camp without taking a deduction, paying them to go to the dentist without taking a deduction, paying them to go to college without taking a deduction. If you could figure out a way to pay your children legitimately, I really want to emphasize that word legitimately, then you pay your child, you take a tax deduction on your business return. They pick up the income on their return, which means most likely they're going to be in a lower tax bracket or a 0 tax bracket. Here's what I mean by that. The standard deduction right now for 2026 is $15,750. So if you paid your child $15,750, they don't pay any tax. So you can issue them a W-2, take a deduction, and they pay no tax. So that's what we mean by organizing your expenses that you're already paying, because you're already paying for college, you're already paying for the dentist, you're already paying for the camp. Now let's take it a step further. Let's say this child now receives this earned income. What if they opened up a retirement account? What if they put $7,000 into a Roth account? Remember, they don't need a deduction because the standard deduction is already taking care of the income that they receive. So they can then open up a Roth account, invest that money over a period of time, and you could create a millionaire, a tax-free millionaire. So organizing your expenses. And then the last category is buy an asset and take the deduction. What do we mean? If you have the ability to invest in certain type of investments, you can write those investments off against any kind of income, take a tax deduction, and then you still have that asset working for you. Two things come to mind. Let's say, for example, you're a W-2 earner, wage earner, and you're looking for deductions to offset your tax. You could invest in something called an oil and gas investment and write off almost 90% of what you invest, take that deduction, and you still have an investment working for you. You still have an investment where you're going to recoup that money. So the three areas again: bring tax-free income to your return, organize your expenses so that you are deducting or benefiting from them, and then lastly, write a check for the tax deduction. So I wrote this book, Overtaxed, because we know that the middle class is overtaxed. All of us feel overtaxed. And so what I want people to focus on is focus on write-on versus write-offs. Most people talk about write-offs. Write-offs are good. We love deductions. But like I said, it's better to bring income to your return that is not taxable versus taking out a checkbook and writing a check for tax deduction. Pay more attention to the write-offs because it's not taxable. It's more powerful. Let me give you a quick example. Let's say that you are in retirement and you receive Social Security, and your Social Security is $30,000 a year. If that's all your income, you pay no tax because the standard deduction and that Social Security will not be taxed because of the amount. But let's say that you have a 401k, traditional, and you roll that into a traditional IRA, and then you take $100,000 from that IRA. Different story. Not only is the $100,000 taxable, but now most of your Social Security is going to be taxed. You're going to bring that into the taxable lane. The result is that your tax bill is going to be about $19,000 a year. But if you had a same scenario, but a Roth account, $30,000 Social Security, a Roth IRA or 401k, doesn't matter, and you take out $100,000, it's tax-free. So not only is it not taxable, neither is the $30,000. So this is why we want people to convert or contribute to Roth IRAs, because in scenario number one, same income, $130,000, you're paying $19,000 a year in taxes. Scenario number two, same income, Social Security, $30,000, $100,000 from your retirement account, no tax. This is why this is very powerful. So we want us to focus on moving away from what I can deduct to what I can exclude, moving away from what I can deduct to what I can exclude. We love deductions. They're both very important. It's just that I find that most people focus just in that area and they miss the big point. Because if you have income, like my previous example, that's not taxable, you don't even need deductions because the income is not taxable. All right, so we want to focus on what we can exclude. And here's the reason. The reason is that many deductions from the past are no longer available. And if they are available, they've been reduced in some capacity. So focus on what I call the upstairs portion of your tax return, the income section of your tax return, because that's where the power is. That's where the chess match is played. I have income that's not taxable. You're king in that scenario. So 2017, the Job Cut Act, I call it a war on Schedule A. Schedule A, just to remind everyone, is where you itemize your deductions. So what happened here is that state and local taxes were reduced to $10,000, meaning that you can only claim $10,000 for state and local taxes. The new law recently increased it to $40,000, but that's temporary. We'll talk about that a little later. So again, I call this a war on Schedule A. These are deductions that people rely on. And when you start to reduce or eliminate these deductions, you're exposed from a tax perspective. Mortgage interest deduction was limited. It wasn't eliminated, it was limited. We'll go over that. And miscellaneous deductions were completely limited. So the point I'm trying to make is that relying on deductions is not the wise way to tax plan. Create income that is not taxable. We talked about the SALT deduction. It is now $40,000. It was reduced to 10, which surprised a lot of us. Mortgage interest. If your mortgage was taken out prior to 2018, the mortgage amount that you can take out and still get a deduction is $1 million. So English translation, if you have a mortgage balance of $1 million or less, and you purchased that mortgage or you took out that mortgage prior to 2018, you may deduct the interest. But if you've taken that mortgage after that date, it's technically December 2017, but to make things simple, we call it 2018, it's easy to remember. Then that amount is reduced to $750,000. So that means that if you have a mortgage balance over $750,000 and the mortgage was recently taken out, some of your mortgage interest is not deductible. Again, it's an attack on Schedule A. So we have to be clear on where we are with some of these items. Miscellaneous deduction, moving expenses. You probably don't remember these now because they're gone. Home office expense. Home office expenses are deductible for a business owner, but not someone deemed a W-2 employee. That's an important distinction. Investment fees, tax preparation, these are gone. For those of you in New York State, these deductions survived. So if you're in New York State, keep a track of these because they do give you a deduction at the state level, not at the federal level. The federal level, they've been eliminated. So let's talk about tax rates, right? And ordinary income, as I mentioned, that's business income, that's W-2 income, that's income if you're a landlord. Ordinary income, the highest rate is 37%, okay? That's also your pension income. That's not tax-free, 37%. Capital gains, long-term capital gains and qualified dividends, depending on your income level, it could be zero. We're gonna talk about it momentarily. You could actually have income and capital gain income and not pay tax at all, depending on your income level. And there's a 15% rate, as you can see, as well as a 20%. But then there's a non-taxable rate. So what we want to do is move to the right. We want to make sure that where is your money? Is your money in the ordinary lane only? Is your money in the capital gain, long-term capital gain rate? Is some of it there? And is some of your money in the non-taxable? So when we work with a client, we try to take an inventory. Where's your money? Is your money all of it in the ordinary income lane? Then you have some planning to do. All right? Let's talk about capital gain rates. And what's a capital gain? A capital gain, the best way to describe it is through an example. You buy a stock for $500, it grows to $700. You have a gain of $200. That gain is taxable. And at what rate? So let's look at this. A single person who has income of $49,550 or less, they don't pay any tax on capital gains. No tax. If they have income in the range, as you can see, of $49,000 to $545,000, the tax is 15%. But these are definitely better than 37%. So again, where is your money? I mentioned these four words. These four words are critically important when you talk about tax planning. Money is taxed differently. Actually, I'm gonna get a t-shirt that says this because this is very, very powerful. So what we have a description, the attribute, and then we have the tax rate. I'm not sure if you can see that clearly, but that says tax rate. So interest income, this is money from a CD, you put money in the bank. That's taxed at the highest rate, okay? Now that's money making money, but why is that? Because the government wants you to invest. They don't want the money sitting in the bank, they want you to invest. So interest income is taxed at the highest rate, it's deemed ordinary, okay? Pension and IRA income. So when you start working and you put money into a traditional 401k, that money, you get a tax deduction for it. And while it's growing, is tax deferred. But when it's time to take that money out, you get hit with a heavy bill. It's ordinary rates and it's at 37%. And there's something in there that says no step up. I'm gonna explain that momentarily. That's very, very important, all right? Also with the pension, the traditional pension, there's an early withdrawal penalty. So if you have not reached the age of 59 and a half, or do not have another exemption from this amount, we add another 10% to that. A lot of times we have people who take money out of a traditional account, they withhold 10% or 20%, and they wonder why they still owe money. Because the money that you took out pushed you into the 37% bracket, then you add 10% on top of that, and now you're talking about 47% in tax, all because you have a traditional account versus a Roth account. All right, let's continue. Dividends, qualified dividends, and long-term capital gains, 15% rate, and there's a step up. Let's talk about the step up now, because it's very, very important. I have a client who I had a meeting with, and we were going over her investments. And I happened to ask about her dad. And she explained to me that her dad was ill at the time, and they were in the process of putting him into a hospice. So, we paused, we talked about that, of course, because that's obviously important. But then as we were talking, she says to me that he has some property that I want to sell before he transitions. I said, really? And then she explained to me that the property was purchased many, many years ago for $30,000 and is now on the market for $3 million. These people lived in Brooklyn. So I immediately told her, I said, listen, don't do that. If you sell the property while he's alive, you're going to have a huge capital gain. The capital gain was somewhere around $700,000 because the selling price of $3 million minus the cost of $30,000 leaves a huge tax, a huge amount of income subject to tax. So I told her, I said, what does your dad plan to do with the property? What was his plan? And the plan was to give it to her and her siblings. So I said, it's best if you sell the property after your dad transitions because there's a step up, English translation. That $30,000 cost now steps up to $3 million. So when her dad transitioned, they now have eliminated a capital gains tax because he sold the property after he transitioned. And that's what the step up is. It's very, very important. There's no step up with IRAs. No step up. So if you have a $3 million IRA and you transition, your heirs are going to have a $3 million, not tax bill, but a taxable income of $3 million. So it's very, very important that we understand there's no step up. Capital gains, again, we talked about this. You sell a stock, you buy a stock for $400, it grows to $1,000, you have a $600 gain. That's taxed at 15% depending on your income level, okay? Better than ordinary, all right? Of course, you have tax exempt interest, and you also have Roth accounts. Roth accounts and insurance, if it's properly planned, it has a zero tax. So remember, we're trying to move from the taxable side to the non-taxable side. So everyone needs to take an inventory of where is your money? Where's your money? Critically important. Money is taxed differently. So again, we want to change our focus from what we can deduct to what we can exclude. And I want to hit this point about Roth accounts because a lot of people think that Roth accounts are for low income earners. There are a lot of people believe that. Actually, that's one of the reasons I wrote this book, because it's not true. In order to have a Roth account, you could have an IRA or 401k. If you have an IRA, yes, there are limits to the amount you can put in based on your income. So that's true. But with a 401k, it doesn't matter what your income level is. You can contribute to a Roth 401k. So this is what's critically important. It does not matter what your income level is. You can contribute to a Roth 401k. And there's something called a backdoor Roth. I'm not going to spend a lot of time now, but I just want you to be aware of it. If your income is too high to contribute to an IRA, there's a way to do it. That's why we call it the backdoor. It's a legal way to do it. So I just want you to be aware of that. When we meet with you, we'll go through detail about how this relates to your particular situation. But the point here is just to understand, even if your income is too high to make a direct Roth contribution, there's a backdoor way to reach the same goal. All right. So let's talk about 401ks for a second. The 401k was created in the 70s, and it really was created as a supplement to Social Security and retirement accounts. But it has grown to play much a larger role into retirement. It was only supposed to be a part of retirement. But now we know that most of us do not have pension plans, and those who do, you're lucky, be thankful. But most of us are looking at Social Security, which we know that's becoming a little shaky, and you're looking at your 401k. The 401k, again, was not supposed to be the bedrock of your retirement. It was supposed to be a supplemental piece of your retirement. So this is why it's very critical that you take the taxes out of your 401k before you start taking money out. It's very important that you possibly could contribute to the Roth side if your employer allows it, or to make. Let me explain that. There are two ways to get money into a Roth account. You can contribute or you can convert, okay? Why is that important? It's important because when you reach a certain age, the IRS is going to demand that you take money out of your traditional accounts. And the reason they do that is because you never paid any taxes. There's no such demand for a Roth account. What I'm referring to is something called required minimum distributions, commonly known as RMDs. Traditional accounts are subject to RMDs, meaning that you must take the money out. You must pay the tax once you reach a certain age, all right? So the point is that 401ks are loaded with taxes. Traditional. IRAs and 401ks that are traditional are loaded with taxes. And it wasn't supposed to be that way, but there was a shift. Employers shifted the retirement burden to the employees. And that's the world we live in. So since we live in that world, we can't cry about it. What can we do about it? We can begin to take the taxes out of our 401k by converting or not contributing at all. Put the money directly into a Roth account. So I'm a CPA. I've been a CPA for a number of years, but most CPAs that I speak with, they say, take the tax deduction and forget the Roth. They always say, you don't get a deduction with a Roth, so why don't you just do a traditional because you get a tax deduction because you're going to be in a lower tax bracket when you retire. That's the logic, okay? Here's why I say it's flawed. Two reasons. Number one, no one knows what tax rate you're going to be in when you retire, all right? What you're looking at right now are the marginal tax rates over these periods of time, all right? So 2008, the tax rate went to 37%, and it still is. That's why we didn't update that, because it's still at that rate. So let's just look at, I want to highlight a couple of things. 2018, the tax rate was 77%. Can you imagine that? I hope we don't see it again, but think about it. And 1981, the tax rate is almost 70%. 70%. So if you make $1, the government wanted 70 cents. All right, so this is critical. I hope we're not going back to those rates, but what's happening with the deficit? We all watch the news. So what do we think is going to happen if there's a major shortfall? You think taxes are going to go down? I think the tax rate is going to go up in the future. So when you're in retirement, do you have any control over that? You have no control what tax rates are now. You definitely won't have any control when you're in retirement. And the other reason I think the argument is flawed is that the CPAs or the other people who say do not do a Roth account, they don't focus on the middle. What do I mean by the middle? I'm talking about the gain. If you put $300,000 into a retirement plan, and that plan develops and invested wisely, and you now has grown that amount to $1 million. So you started with $300,000, now you have $1 million. That's a $700,000 amount of a gain. In a Roth account, and hear me well, that's tax-free. In a Roth account, the $700,000 gain is completely tax-free. In a traditional account, it's not. That is the difference between a Roth account and a traditional account. The gains are not taxed. The 300,000 is taxed in both scenarios. The difference is in the traditional account, the 300 is taxed when you come out. In the Roth account, the 300 is taxed when you go in. But the 300,000 is nevertheless taxed. It's the 700,000 that I focus on. And that's what I want you to focus on. We want to play chess, not checkers. The 700,000 is where we want you to focus. That is not taxed. So they missed that point, and hopefully you won't. So let's talk about the Roth versus traditional and which one's better. And I think this table would give us a better understanding of how this works. So on the traditional side, the contributions are $585,000. This is over a lifetime of working, a period of maybe 30 years. On the Roth side, and these are 401ks, right? Traditional 401k versus a Roth 401k. And remember, you can put money in a traditional 401k. You can also put money into a Roth 401k, regardless of your income amount. I want you to clearly remember that. So now, the contributions are $585. The assumed growth over this period of 30 years is 2.9. So at the time of retirement, the account has a balance of $3.5 million. Same amount, both sides. The tax rate on the traditional side, let's assume, is 24%. That means that the tax due is $840,000. So on the traditional side, I never paid tax on the $585. Now I have to pay tax on the growth. So that 3.5 is all taxable on the traditional side, resulting in $840,000 in taxes. On the Roth side, I pay taxes on the 585 because I paid tax when I went in, remember? The Roth you pay as you go in. The growth is tax-free. So when I have my 3.5 in a Roth account, my tax rate is zero. Zero. The tax due is zero. Now let's talk about when you went in. When you put money in the account on the traditional side, there was no tax due, which is a good thing. That's good. On the Roth side, there was a tax due, and that tax was $140,000. So when you compare the total tax of $840 traditional and $140 Roth, the savings is $700,000. This is why we recommend a Roth account. It's about the growth in the account. Why do we invest? To lose money? Not me. You invest to grow. And so the money that grows in the account is tax-free, and that's why this is powerful. Let's talk about another benefit or another angle to create tax-free income, and it's life insurance. When I read the tax code regarding life insurance, it appears that the life insurance industry wrote it because there are no taxes due if you do things a certain way. There's no tax due. So when you purchase a life insurance policy, the main reason you should do it is to cover someone's life. But there are other benefits if you have a permanent policy. A term policy is just a death benefit. A permanent policy is a death benefit plus an investment. The death benefits are not taxed. Now let's talk about the cash value or the investments that are grown inside of a life insurance policy. So when you have a life insurance policy, those dividends and interest, as they're growing, they're not taxed. And if you take it out the right way, and the right way is through a loan, it's not taxed. So let me give you just a general example. If you have a policy that has a death benefit of $1 million and you have cash value that has grown of $100,000, and now you're still alive, it's your policy, and you want to take out that $100,000, you may take it out in the form of a loan. When you transition, your heirs won't receive the million, they will receive $1 million minus $100,000. But they don't pay any tax, and neither did you. Now, universal, index universal life is a particular type of policy that I like, and here's the reason why. No taxes, but you also avoid investment risk. What do we mean by that? Inside of the index universal life insurance policy, you can have an investment where you protect yourself on the downside and you're capped on the upside. So when we speak with you, we go into detail about that. But the key thing to remember is that inside of an index universal life, you have a tax benefit and you also have a benefit from market risk. So as you diversify not only your portfolio, but you diversify your products in terms of what type of accounts that you have. So this is why the index universal life is an important policy. One of the drawbacks, of course, is that you're capped. Let me explain what I mean by that. When you select a index universal life insurance policy, you mimic a index, and it's called the S&P. So you may have a scenario where you say, I'll participate in growth up to a certain point. Let's call it 12%. And I have complete downside protection. So if the S&P goes up to 20%, you don't participate in the 20, you receive a 12% hit. So that's the downside. But the reality is you're diversifying, all right? So it's something to look into because you're not paying taxes on what's earned and you're not subject to market losses because you have the ability to protect yourself on the downside, right? Protection is critical, all right? So there's a choice. I started off by telling you I feel that retired persons should be tax exempt. That's not the law. We know that's not the law. But if they plan properly, you can get there. You can absolutely get there if you plan properly. But you have to start now. And you have to focus on the upstairs side, bringing income to your return that's not taxable versus writing a check for tax deductions. Of course, we love deductions. We put it all together, but we want to look at where you stand so that we can help you transfer wealth to your family tax-free. Because that's what it's about. It's not about what you make. It's about what you keep. And keep means keep it away from the tax authorities legitimately. All right. So when we work with a client, we calculate sort of internally what is their tax smart assessment score. Again, remember we talked about income, ordinary income. If you're in that lane, you have a low tax assessment score, meaning where your money is. All right. So we want to move to the right. We want to move to the right where we can get you in the tax-free lane. All right. Retirement spending clarity. I just met with a client a few minutes ago. We were talking about how each dollar is going to help her in retirement. Where's your money going to come from? When you stop working, it's a very scary situation because there's no salary anymore. So where's that money coming from? What do we need to do to make sure that everything is in order? All right. So we help people with something called a Roth conversion savings report. When should you, first of all, should you convert? What is it going to cost you? And then what's the benefit? This is what we help clients with. Entitlement of assets, making sure that your assets are titled properly. Like I talked to the client who was going to sell her dad's home. That could have been a major problem. That was a $700,000 conversation. Seriously. So we do an inventory and go through those kind of things with you. So in conclusion, what we want to make sure that you understand is that every dollar in your portfolio, even outside your portfolio, needs instructions. They need instructions. And putting a plan together to make sure that you're minimizing taxes, maximizing your investment returns is extremely important, extremely intelligent. How are we doing on time? I want to hit some highlights on the big, beautiful bill, the so-called big, beautiful bill. And why it's important to focus on the income side of your tax return, all right? So here's some highlights of that bill. The tax cuts from 2017 were extended or made permanent, okay? There are no income on tips up to 25,000. But look at this. It started in 25, but it sunsets in 28. So it's sort of like a gimmick. So don't focus on the deduction side only because you're going to miss the point. Overtime pay up to $12,500 is tax-free. But look, it started last year in 25, but it sunsets. It's over in 28. It sounds good, but that's not where your long-term plan should be. The standard deduction went up. We talked about that. For a single person's, it's $15,750, and married it's $31,500. Those numbers change every year. SALT, this is your state and local income tax or property taxes. They capped this at $10,000. Now, they've increased it to $40,000, but it sunsets in 2029. So you can enjoy this while it lasts, but it's not going to last very long. Car interest deduction. This hasn't been around for many years. You can deduct interest on a brand new car up to $10,000. Okay. And then there's a senior tax deduction. This is good. So if you've reached the age of 65, you get an extra deduction of $6,000. Very good. That gives you opportunity to do a Roth conversion. And there's a bigger tax state exemption. What do we mean by that? Once you pass away, your accountant, your lawyer is going to add up all your assets. And if they exceed $15 million, you owe the government some money. So that exclusion has been made permanent. All right. But what I want to talk about provisions made permanent and temporary, which we just to outline them. So the individual rates are permanent. That's good. We like lower rates because they were higher before. We hope they don't go up. But realistically, what do we think is going to happen as the deficit and inflation? What do we think is going to happen? The standard deduction was increased, as we talked about. Child tax credits are permanent. The state and gift tax is permanent. Temporary. Let's focus here. SALT is temporary. The interest on the car loan, temporary. The senior tax deduction, temporary. Deduction on tips and overtime, temporary. What's the point? Focus on the upstairs part of your tax plan, bringing income to your return that is not taxable. I appreciate you guys listening. We have a few questions. And what we're looking at here, if anyone is interested in setting up an appointment, you scan the screen. We also have a book that we wrote, Overtaxed. We would love for you to take a look at that and see how you could not be overtaxed. And then also I have a course where we talk about how to be tax-free in retirement. So you can scan those to kind of look to see where we are. All right, so what I'm going to do, we have a few questions. I guess I'm going to read them, which is fine. All right, so one question that was sent to me is that if I already have a 401k at work, can I still contribute to a Roth IRA? So if you have a 401k at work, yes, you can contribute to a Roth IRA, but you have to check your income level because depending on your filing status, your income level, you may not be able to. But generally the answer is yes. You may have a 401k and you may also have a Roth IRA or a regular IRA. Okay, so the answer to that question is yes. Why would someone choose a Roth IRA if the contributions are not taxable? Sounds like one of those accounts I was telling you about. So again, when you put money into a Roth IRA, there's no tax deduction, but the growth in that account is tax-free. I talked to you about an example of someone who's receiving $100,000 a year, tax-free. Nothing's taxed. They received $30,000 from Social Security. They received $100,000 from their Roth account, and their tax bill is zero. So, no, they did not receive a deduction when they made those contributions into the Roth account. They did not. But they're living tax-free in retirement versus someone who took a deduction yesteryear. Now they receive $30,000 in Social Security, and they receive $100,000 from their retirement account. They're paying $19,000 in taxes. All right? So you multiply that out by 10 years. It's 190 grand that you're paying extra in taxes because you didn't Roth. So planning is critically important. I think we have time for one more. What happens if I need to withdraw money from my Roth account before retirement? Excellent question. And what I think they meant to say is before I reach age 59 and a half. A Roth account is tax-free if you held the account for 5 years and you reached the age of 59 and a half. Held the account for 5 years and you reached the age of 59 and a half. The growth is tax-free. But what if you did? What if you did not reach the age 59 and a half? Then some of your distribution is taxable. But here's how it works. And this is critically important. It's an excellent question. It's critically important. And here's the difference between a Roth 401k and a Roth IRA. So with the Roth IRA, the money you put in is never taxed. So if you put in $20,000 in a Roth IRA and it grew to $50,000, and now you need some money and you want to take out $10,000, there's no tax. Why? Because you put in 20. The money you put in the Roth account is not taxed. However, if you took out more than 20, then there is going to be a tax calculation on the amount over 20,000 if you hadn't held the account to the age of 59 and a half. On the Roth 401k side, any amount you take out before 59 and a half or before holding that account for a number of years, it's always going to be some tax. But the calculation of the tax is based on what you put in the growth. So it's a combination. So what's the message? The message is if you're going to take money out of a Roth account prematurely, transfer the money from your 401k Roth to your IRA Roth and take the money from the IRA Roth because you have more chances of that money not being taxable. Again, we want to thank you guys for listening. We appreciate your time, and we would love to speak with you directly because this is general information. We want to relate it to your particular case. And again, we start with an inventory. Where's your money? Where is it? And what do we need to do to get that money to transfer? So again, we want to thank you, and hopefully we'll be in touch with you very soon. Thanks again. Bye-bye.